Hey there, teachers and public employees. Welcome to the Public Employee Retirement Training Channel, where we help public employees like you prepare and plan for retirement. In this video, we're talking about pension loans. If this is your first time on the channel, don't forget to subscribe and check out the retirement roadmap in the description below. Let's get into pension loans. Many times we find ourselves in need of some funds for a new roof, some home repairs, or when one of the kids needs braces. If you are thinking about borrowing money from your retirement, then this video is for you. You may have heard of pension loans, 403(b) loans, or even taking out a personal loan, but how do they compare and which is right for you? Let's break it all down in simple terms. Part 1. What is a pension loan? A pension loan allows you to borrow money using your future pension income or pension contributions as collateral. Each local or state retirement system or pension plan has different rules and criteria for pension loans, but this video will give you a basic understanding as to how the loans work, the pros and cons, and how pension loans compare to other types of loans. But here's the twist: you're not borrowing from your actual pension plan. You're borrowing from the pension system and/or a third-party lender who gives you a lump sum now based on a portion of your future monthly pension payments, or the amount you have contributed towards your retirement. You repay the loan through payroll deductions or a partial or lump sum. These payments will be in addition to your normal pension contributions that are deducted from each paycheck. Part 2. Pros and cons of pension loans. Pros: quick access to cash. No credit check. Doesn't require assets outside of your pension. Potentially low interest rates. Cons: reduces future pension income. Potential administrative fees. Loans must be repaid in a certain time window. Part 3. Pension loan versus 403(b) loan. A 403(b) loan lets you borrow from your own retirement savings, if your plan allows it. You typically repay the 403(b) provider, with interest, over 5 years. That is one caveat: these loans must be repaid within 5 years. With a 403(b) loan, you keep control of your retirement assets, and can essentially borrow against the account balance, typically up to 50%. For example, if you had $100,000 in a 403(b), you could borrow $50,000. Pension loans and 403(b) loans typically have lower interest rates than personal or unsecured loans. They also require no credit check and will not impact your credit score. Part 4. Pension loan versus personal loan. A personal loan is an unsecured loan from a bank, credit union, or online lender. You get a lump sum and repay it over time with interest. Personal loans are more flexible and don't touch your retirement, but they're harder to qualify for if your credit isn't great. Part 5. So which loan is best? If you're still working and have a 403(b), borrowing from yourself might be the smarter move. If you're retired and out of options, a personal loan may offer fast cash, but at a cost. The decision will largely come down to interest rates, the time horizon in which you can repay the loan, and how much cash you need access to. Retirement is your future. Borrow smart. Stay informed, stay prepared, and here's to your bright future ahead. If you want to improve your financial literacy, create a financial plan for yourself and your family, or start planning for retirement but are not sure where to begin, be sure to check out the retirement roadmap in the description below. We hope you found this video helpful. If you did, share it with a fellow teacher or public employee. Be sure to like, subscribe, and hit the bell so you don't miss any future videos. Drop your questions in the comments, and thanks for watching.